Hello investors and traders, and welcome to this week's Technical Tuesday educational video, where today we're going to be covering the power of the role reversal. Before we get into the content, let me first mention that our company is built on a foundation of risk management, and we follow the 1% rule for managing risks. So while you're learning about the role reversal for ways to get into a particular trade, looking for your exit and your entry points, make sure that you also learn how to use the role reversal for managing risk when a trade eventually moves against you, and that will almost always happen from time to time. So knowing how to control the risk or limit the risk is what helps you preserve your buying power. Now let's talk about the forces that drive prices up and down. There is a misconception out there where many people believe that prices go up because there's more buyers than sellers. But the fact is, prices go up when the buying pressure exceeds the selling pressure, and that's what leads us to higher prices. And on the opposite side of the coin, when the selling pressure is greater than the buying pressure, prices go lower. And so when you're looking at a chart, you have to first understand that the price action is giving us the direction, but it's the volume that measures the force of the move. Now, a couple of months ago, we put out a Technical Tuesday video teaching our audience how to read volume as a leading indicator. So you might want to go back and look at that as a refresher. So the direction of the trend tells us who's in control of the price, but the volume is the leading indicator that tells us when the trend is about to shift. So when you're factoring in volume as the force behind the move, you have to then recognize what support and resistance looks like on a chart. Defined, it's pretty simple. Support occurs at the point where a downtrend is expected to pause due to a concentration of demand. Right? You may have learned that in school, where supply and demand is a big part of economics 101 and 201. But when it comes to trading, you have to know when the buyers are stepping in or when the sellers are starting to move in, so that you know how to take action. And again, like I said before, you have to know how to manage risk. Another way to define support is when the sellers are in control of the price, pushing it lower, and then the buyers step in and say, okay, we find value here, therefore we're going to start to buy. That's where the support levels show up. On the opposite side of that, resistance occurs at the point where there's an uptrend. So in other words, the buyers are in control and it's expected to pause. So the uptrend is starting to weaken. That's again why we have to look at volume. And the trend is weakening, or up leg, I should say, as traders look for up legs and down legs. The up leg is expected to pause because there's a concentration of overhead supply. And again, the volume will show this. Go back and watch that video and you'll see exactly how that works. So the role reversal is basically a relationship between support and resistance. Now, in my stick figure example of what the role reversal looks like, you can see here the price is moving up very nicely, and then all of a sudden you'll start to see the volume drop right around this area here. It hits resistance and starts to pull back. So at that peak, you can look at that also as an inverted V. Resistance is now marked. Well, eventually what happens as a stock oscillates and goes through what very closely resembles an ABCD pattern here, eventually buyers will find value and they'll start to push it back up, and they'll continue with their buying until the price breaks out over resistance. Now that's where the dynamics shift from resistance to a new support level, because the resistance, once broken at this point here, reverses its role and turns into support. Some analysts will call this a step-up pattern. I like to keep it super simple. Let's just call it role reversal, and knowing how to trade this is going to be most important, because this, in my opinion, is one of the most important price patterns you could find on a chart. And I could pull up basically any chart and find you a role reversal area, whether it be a role reversal to the upside or role reversal to the downside, which we'll get to in a minute. But there are certain behaviors that take place in the market that cause this pattern to mature and play out to where resistance reverses the roll into support. It starts with the breakout. Right now, there are many short-term traders who are just incorporating a breakout strategy, and that's all they do. So they look for resistance levels, they'll read the volume, and as the stock is moving up to the resistance area, a lot of times you'll see the volume build up underneath the price action, and that's a telltale sign that we're most likely going to see a breakout. So the short-term traders, even day traders, jump in at that particular point in time, and the force on the demand side pushes the price higher. Now, eventually what happens is the short-term trader is now looking for a place to take profit. Now, those who are right on the market are going to be the first ones to take a profit, but then you always have the procrastinators. They're going to wait a little bit longer and see if it continues to go up, and they wait and they wait, and guess what? The price starts to drop, and now they're selling out, still being able to squeak out a profit. And then what happens, you have the FOMO traders jump in. They're the last ones to get out, because now they're fearing that they're going to lose whatever little profit they have, or maybe even take this profitable trade and turn it into a loser. And that's when those buyers who got in on the breakout are completely out. So when the selling is exhausted at that particular point in time, we generally see bounces at that new support level. Now, I like to trade both areas of this role reversal. I like to trade the breakout, and if I'm too late to the party and I wind up missing this up leg here, I'll wait for the pullback and then the pivot to form at the new support, at which time I will buy the stock and then put my stop somewhere below that support level. Now, like I said before, it happens on the way up and it also happens on the way down. I'm not going to get into the strategy on how to trade the role reversal on the short side, but I want you to know that the dynamics are the same. With the roles are reversing in that buyers come in and buy at support, but when they hold on too long and it starts breaking out below support, they're putting stop loss orders in to protect themselves, but the price usually drops for a certain period of time as those stop orders are triggered. And then once the stop loss orders have been exhausted, we'll generally see a bounce up to the former support here, which now turns into resistance. Now, for option traders, this area of resistance, the role reversal resistance, is a great place to be playing directional puts. And of course, you have to manage risk on those as well. So let's take a look at an actual chart so I could show you how you would draw these horizontal lines. Okay, so this is a real candle chart taken from a stock that I clipped today to get this image. And at first glance, you may not see the role reversal as we just saw it in the stick figure example. But this is what it looks like. You can see back here, this high, which is an inverted V, right? There's your resistance right there. And it is broken right here. And you can see how it rallied up for a few days, reached the high, and then the profit taking took place and it pushed it right back down to the original breakout point. And then what happened? It bounced and it went up to a new high, pulled back, tested that high again. So you have a double level, if you will, of resistance where it's been tested 2 times and fell back. But it's right at this area right here where you get the breakout. Now remember, you usually see an increase in volume on this breakout as the swing traders and even day traders make their move to capture that momentum to the upside. And then what happens? They start to take a profit, pushes it back down, and what does it do again? It bounces off of this support. And it's more or less a, wash, rinse, and repeat type of a strategy. This works very well in stocks that are in upward trends. It doesn't work so well in stocks that are in sideways trading ranges. But you have to understand that the stock selection process is part of the risk management plan so that you can go out there and find stocks that are seeing this regular role reversal pattern. Now, when it comes to risk management, how do and where do you place your stops? Well, let's say that you buy here because you're like me, you're waiting for the bounce off of this newly established support and you're taking a run here. So when you're buying in this area right here, you're putting your stop somewhere below that support level. And as the stock continues to move up, you're trailing your stop up with the price of the stock. Now, once it breaks out over this resistance here, you're most likely going to see another run in the short-term price action. So you have to protect the profits that you have at that particular point in time. So you're moving your stop up, but then you have to anchor it once again below this key role reversal support level, because look what happened shortly thereafter. It rallied up, and if you didn't take your profit at the high right here, then you're subjecting yourself to the possibility of giving back all those profits, hence the reason why you have to put your stop below that support level right here. And you can see what happened after the stock gap down after that. So if you weren't careful and not using stops, you could have given back all those profits and maybe some more. So let's take a look at some actual charts. This is AutoZone, right? Ticker symbol AZO. And you can see that there are different areas on this chart where you see the role reversal. Let me just draw those out for you. Here's one right here. See this resistance area right there? And look what happened. It held the support very nicely and rallied up. So you're trailing your stop. Then what happened? Here we go again. It broke out and hit support. There's your role reversal. Later on, as you can see, what happened up here is the stock hit resistance. It pulled back, broke out of resistance, bounced off of this support level right here, continued up, and then went and took a trip to the downside. So again, the importance of protecting your profits along the way by trailing your stop is something you want to get in the habit of doing. Otherwise, you're going to be spinning your wheels and churning your own account, not doing very well taking your profits. So that is it. If you like this video, go ahead, hit the like button. And if you have a question about what I've talked about here today, feel free to put that question down in the comments field and I'll do my best to track those questions. If you're one of our regular viewers, you'll know that I do my very best to address or answer any questions and comments that come into the comment field. We want to deliver that value to you so that you can continue to learn and maybe get good enough for trading so that you could teach others how to do the same. And hopefully when you get to that point, you teach them how to manage risk as one of the most important concepts of trading. So again, please like, share, subscribe. And we thank you so much for subscribing and liking our channel, because that's what's helping us grow. And we really appreciate that very much. So have a good day. Take care.